Hi guys, it's Carl Allen from Dealmaker Wealth Society. Today I'm going to teach you all about how to build an offer sequence that will help you with your negotiations when you're buying a business. And it's very rare in business buying that your offer will be accepted in its very first iteration. There's always some kind of arm twisting or negotiation in order to get to a deal where everybody wins and everyone's happy. So with this method, the offer sequence method, I'm going to teach you how to structure your offers for maximum leverage. And with this principle, your offers can be rolled out every 3 to 4 days for the best possible opportunity. And the offers can be stacked on top of each other or they can be mixed and matched. So I'm really excited to show you this. So let's get started with today's training. So let's get started. So first, let me explain to you the principle of offer sequencing. So if we draw a little chart where we've got valuation on the one axis, and on the horizontal axis, we've got time. So what happens is when you first look at a deal, and this is especially the case if the business is being sold by a business broker. So what you typically have at the start is you have an inflated price expectation. If you've spoken to a lot of brokers, you've been looking at their deals, you know that brokers will artificially overprice a deal in most cases. So what happens is you've got that very inflated kind of price situation. And then what we're going to talk about today is how you can make offers on this business which go up sequentially without putting the deal at risk. I'm going to show you an example of a simple deal in a minute, but I'm going to show you how you can structure your offer in incremental steps so that you can get the deal closed. And what happens is over time, those inflated seller expectations start to come down. You start to see movement. And if you've got a business that's a good business, but it's owned by a distressed seller, then your price expectation may be here. So this is where the distressed seller lives. So what you find with distressed seller deals, so not distressed businesses, good businesses with distressed owners, something going wrong with their mindset. So they want to sell because they're tired or burnt out, frustrated, want to retire. They could be sick, could be dying in some cases. And what you tend to find is sometimes a low offer can still get that deal closed. And the job is to really submit these offers in a sequential way. And the issue is having these offers already in place before you make your first offer. So don't make offer one and then if that gets rejected and you get a counter, then go back and start looking at all the other offers. You want to have each of the 6 offers laid down, analyzed, even the offer letters ready, so that you can send them out every 3 to 4 days. And what's really interesting is you can build these in combination or you can mix and match these offers. It's completely up to you, but I'm going to show you what these 6 offers will look like on a sample deal. So before we go through the offer sequencing, let's go through an example deal. So let's assume we're buying a professional services company. So it could be PR, advertising, it could be a marketing agency, it could be an IT services company, it doesn't matter. And let's imagine that this business has got $2 million in annual revenues and it's got a 10% profit margin. So not bad, but not great. So the profit in this business is $200,000 per year. 10% of 2 million is $200,000. And let's assume we're going to be buying this business at the average kind of multiple. So the multiple is at 2.5 times the profit. So we are going to be paying $500,000 for this business, okay? Nice and easy. So now let's look at the financing. So it's a professional services company. So it's not got really any assets, got no real estate, got no plant, got no equipment. It's profitable. But what it does have, and this is really the rocket fuel for all leverage buyouts, is it has accounts receivables. Now accounts receivables is the book of invoices that have not yet been paid by the customer. So the services company has delivered the service to the customer, sent the invoice, and because of the payment terms, they haven't yet been paid to the customer. And the way we measure that is on the number of days of revenues, or DSO, days of sales outstanding as we call it. So on average, a professional services company like PR, advertising, marketing will have 90 days of receivables outstanding. So 90 days is $500,000. So we've got a $500,000 accounts receivable book on the balance sheet. And we know that we can get at least 80%, but let's call it 70% loan to value against that asset. So if we go to a financier or a bank, we're going to get roughly $350,000 of financing. Okay, so that's a nice big chunk of the $500,000 that we need to pay for the business. But we're not going to pay the whole $350 to the seller at closing, because we might do $250 at closing, which is a nice closing payment. It's 50% of the total valuation of the business. We might take $50,000 as a fee for ourselves for doing the deal, and then we might need $50,000 in fees for our advisors that are going to close the deal for us. So CPA, who's going to do the financial due diligence, and the lawyer that's going to do all of the transactional paperwork for when we close the deal. So we're paying $250,000 at closing. That leaves $250,000 left in seller financing to pay for the business over time. And let's say we're going to do that over 3 years. So that's nice and simple. It's $83,000 per year. So that's our deal. It's a $2 million revenue business, 10% margin, or $200,000. We're buying it for a 2.5 times multiple. $500,000 is the purchase price for the business. We know that it's also got $500,000 of accounts receivables on the balance sheets, 90 days of revenues. We know that we can get at least 70% loan to value on that, which is $350,000. And we're going to use $250 of that to pay the seller at closing, take $50 for ourselves, and then $50,000 in fees. And then we know we're going to pay the other $250,000 over 3 years, which is $83,000 per year. So we're going to have $117,000 per year for ourselves, because even if we don't grow the business, it's cranking $200,000 a year free cash flow. We're paying the $83,000 per year in seller financing. The AR facility, that's a revolving line of credit, so we'll have a little bit of interest on that, but we know we're going to be getting between 110, 120 a year in free cash flow for ourselves. This is a really good deal. Now, before we make that offer, I want to take you through the offer sequencing methodology. So here are the steps. We're going to offer on this business in 6 steps. I'm going to tell you what they are, and I'm going to show you what the numbers look like for this particular deal. So the first thing we're going to do is we're going to take the base offer that we've just calculated, but, and it's a big but, we're only going to offer 75% of the closing payment. That's step number 1. Step number 2 is we're then going to offer the full base offer. So once we've made offer 1, we make sure that we get a counter. We might be nowhere near, but as we mentioned before, we'll start to see movement as this offer sequence plays out. So step number 2 is the full base offer. So it's what we agreed on the last sheet, but it's with 100% of that closing payment. Step number 3 is it's the same base offer, then we add 1 more year of seller financing. So rather than do it over 3 years, we instead do it over 4. So it doesn't affect our ability to pay for the business. We're just paying that $83,000 per year 4 times instead of 3 times. Now, if that doesn't work, normally at step 3, you're normally good. But if that doesn't work, we can introduce an earn-out, which I'll walk you through what an earn-out means in a couple of minutes. If that doesn't work, then you must really have deal heat. Normally, you would move on to the next deal in your funnel. But if you're not that far away and you want to keep pursuing it, then step number 5 is you can leave the seller with, say, 10% of equity. Instead of buying 100% of the business, you're buying 90% of the business. And if you've built a great relationship with the seller, really believes and trusts that you're the person that's going to take the business to the next level, he or she might want to leave a little piece of retained equity, because if you're buying it for $500,000, you grow it over a few years, then you sell it for, say, $5 million, then 10% of $5 million could be an extra $500,000 that the seller gets in the future based on all your hard work riding your coattails. And you think, well, that's not fair. But if it's the only way to get the deal across the line, it's better to own 90% of a deal than 100% of nothing. And then step 6, you really must have deal heat. I never really go to step 6, but if you're really close to agreeing a deal and you just need a little bit of extra cash at closing, then what you can do is you can actually sell equity to a third party. So you might sell another, say, 10% of equity to an angel investor. So somebody that can put some more cash into the deal, allows you to pay more at closing, which is always a good thing, not for a buyer, but for a seller. And you've got a partner then that you're able to run that business with going forward. So those are the 6 steps. Now I'm going to walk you through how that would work on our example deal. So here's the offer sequencing matrix. So I'm going to walk you through what these items are, and then we're going to populate it with our live deal. So we've got the offers 1, 2, 3, 4, 5, and 6. 1 being your lowest offer, 6 being your highest offer, if indeed we ever get there. And then across the top, we've got the different components of the deal structure. So we've got the closing payment, we've got seller financing, we've got earnouts, we've got any retained equity for the seller, we've got any equity that you're going to sell to a third party like an angel investor. Then we've got the total value of the deal, and then we can calculate what the increase in dollars is for each deal step and the percentage increase as well. So let's go with our first deal, our first offer. So the closing payment is only 75% of the total. So the closing payment on the first offer is only $190,000 because it's 75% of the $250,000 that our base deal calculated. And our seller financing, we're not going to increase that. We're going to keep that at $250,000. There's no earnout. There's no retained equity for the seller. There's no selling of any equity. So the total value of that deal is $440,000. So there's no increases yet to talk about. So if that is rejected by the seller, don't move to offer number 2 until they give you a counter. So we don't know where they are yet in that original diagram that I drew for you, talking about inflated seller expectations and when they start to move based on your relationship with that seller and how much you're understanding the seller psychology. So you've made offer 1, it's been countered. Now go in with offer number 2. So offer number 2 was our base offer. So that was $250,000 as our closing payment. The same $250,000 in seller financing. We've got no earnouts again, no retained equity, no seller equity. So now we're back to the $500,000 total value of the deal. So by doing this, we've actually now increased our offer by $60,000, which, if my math is correct, is about 14% increase. So offer number 2, we've started now to make some positive steps about increasing the value of our deal. Now, if 2's rejected and they come back with another counter, then what we can do is we can add that extra year of seller financing. So instead of paying $83,000 a year times 3 to get us $250,000, we're now going to pay $83,000 a year times 4. So offer number 3 is we've got $250,000 as our closing payment, but now our seller finance is $333,000. Again, no earnout, no retained equity, no seller equity. So now the total value of our deal is $583,000. So now we've increased our offer in total over offer number 1 by $143,000, and that is a 33% increase on our original deal. Now, if that's rejected, you must really have some deal heat. But we go to offer number 4. Now we can start to introduce the concept of an earnout. So an earnout is an additional bonus payment that you make to the seller once revenues or generally earnings go above a massive level. So it's a bonus trigger payment, but it doesn't affect your all-important mechanics of doing the deal. It's just super high performance. You can pay additional money, and you can factor that into your deal. So offer number 4, everything's exactly the same as before. We've got a $250,000 closing payment. We've got $333,000 in seller financing. And now let's look at an earnout. So let's say you're $100,000 short on the total deal structure. So you might say, okay, Mr. Seller, I'll give you $100,000 of earnout. And what you might do is say, I'll pay you $25,000 per year times 4, because again, it's a 4-year deal now. That's 100 grand over 4 years, 25 grand a year. And it might be that for every $50,000 of incremental profit, or every $100,000 of incremental profit that you make over and above the $200,000 a year that the business is generating now, you will pay that seller that extra $25,000. So it doesn't affect your cash flows of the deal whatsoever. You're just sharing in a little bit of that upside. So now, again, we've got no retained equity, we've got no seller equity at all. Now we're at 683,000 in total offer, and we're 243,000 over and above the original offer that we've made, and we're now at 55% higher than where we actually started. So we've made some massive strides in sweetening this offer for the seller, but without putting the deal at risk. We've not changed any of the cover ratios, we've not changed any of the cash flows. All we've done is really, offer number 2 was where we were originally very comfortable. We kind of tested the waters with a cheeky lower offer at 1. All we've done is we've extended seller financing, and we've increased the deal with an earnout, which again is cash neutral for you. If you're paying $25,000 for every $50,000 of extra profit that you generate, you're both winning. You're making 25, the seller's making 25. It's a completely normal thing to do in any negotiation. So now, $683,000 for this business. This is a really strong offer. Now, normally when we get a past offer number 4, if the seller's not interested, if I'm not right there, I'll just move on and go to a different deal. And sometimes the seller will rebound and come back to probably that offer, and then I can start negotiating maybe further back down. However, let's say you really like this business. It's really in your sweet spot. You can add massive value to it. You might want to go to step number 5. So step number 5, again, exactly the same as before. We've got $250,000 as a closing payment, $333,000 in seller financing, $100,000 in earnout. But now what we do is, instead of buying 100% of the business, we buy, say, 90. So we buy 90% and we leave the seller with 10% of the business. So now what we do is we say, well, okay, Mr. Seller, on offer number 4, it was a $683,000 deal. Now, if I'm giving you 10% back in terms of the equity, then I'm adding $68,300 to the purchase price, because now I'm only buying 90% of what that was. I'm not selling any equity to anybody else, but now I've got $751,300 as my total offer. So now we're going even higher. We're now 71% above where we started, and we've increased the total deal by about $311,000 and change. Now, if that doesn't work, you really should be moving on to the next deal. But let's say your sticking point is closing payment. Let's say you needed to add a little bit more cash at closing. You don't want to put the cash in yourself. You've kind of maxed out with the accounts receivables financing. So you need another, say, $60,000, $70,000 at closing. And what you can do is you can sell a piece of the equity to an angel investor. So you can add another $68,300 in here, and that effectively gets added to your closing payment. So let's keep the $250 closing payment here from the seller financing. We're adding the extra $68,300. All these numbers are exactly the same, but now we are at roughly $820,000 for the total purchase of this business, and we're at about 85% higher than where we actually started. We've increased the total value of the deal by about $380,000. Now, normally I never go beyond number 4. For me, asset-based lending, earnouts, and seller financing, those are the bits that I'm really considering myself with. If offer number 4 is not accepted, I just tend to go on to the next deal. But you can, without impacting the cash flows of the business, go down to some of these other offers as well. So there you have it. You now know how you can build an offer sequence and roll out up to 6 offers in total every 3 to 4 days. This is going to give you maximum leverage in your deal making so you can structure a deal where everyone wins. So thank you so much for watching. I hope this helps you with your negotiations and gets you one step closer to buying a business. In my Dealmaker CEO program, I cover all of these steps in this business buying system. But if you're just getting started in your deal making journey, I've got a free gift for you. You can click the upper right corner of this video or in the description below for the link to my business buying blueprint, how to own an established and profitable business in under 99 days using none of your own money. So get your copy for free by following the link. And thanks again for watching. If you've liked the video, please subscribe to our channel and like this video. We upload new videos on Tuesdays and Thursdays, and we're sharing plenty more tips and tools and mindset tricks and more to help you jumpstart the lifetime and the lifestyle of your dreams and becoming a deal maker. So that's all for today. Stay tuned for more from the Dealmaker Wealth Society, and until then, bye for now.